Hi, this video is very important for all those who are buying and purchasing shares or appearing in a professional exam. In this video, I'm going to tell you practically how to minimize your losses when you're buying and selling shares. In other words, I'm talking about hedging. Hi, if you're new to my channel, I'm the commerce specialist. I create content covering learning outcomes of various academic qualifications and professional certifications, including life-changing business ideas and hacks. So in this video, I'm going to focus on a special derivative which we call options. So what is option? Option is a derivative. In other words, option is a right or a privilege, but not an obligation for an option holder to buy or sell a specific security, which means shares, at a specific time or before a specific time at a specific price. So remember this, option is the right or privilege a person has who is the option holder. It is not an obligation. So what right he has? He has a right to buy a share or to sell a share at a future date, at a specific price, or sometimes before a future date. And these options are used to minimize risk. Here you need to understand there are also some options which are called stock options. Stock options are given by companies to their employees as an incentive. But these stock options are not traded actively in the open market. And what happens if these options, stock options, are not exercised by the employees? They expire. What we are talking about is options to buy or sell shares. So here you need to understand we are talking about stock options which are created by an investor. When we talk about options created by an investor, the two common ones are known as call option and put option. Under a call option, let's say if I am an investor, I purchase a call option. Now what does this call option or derivative gives me? It gives me the right to buy a particular share, a particular stock at a particular price on or before a particular date. So let me explain you. If I buy a call option, if I'm an investor, if I buy a call option today, okay, today. So today the price of XYZ company's share is $10. Okay, if I pay to buy a call option, let's say $3. So if I'm spending $3 to buy the call option, what right it gives me? It gives me the right to buy XYZ's company share, which is $10, let's say after 2 months at $12. So what if after 2 months the price of this share is $25? Still I can buy for $12. If I buy a call option entitles me, gives me the right to buy the shares at a future date. Future date means after 2 months at a specific price, which is $12. So today the transaction price, the day I'm buying the call option, if the price of a company share is $10, I'm paying $3 to purchase the call option, which is called the option premium. So that entitles me to purchase the same shares of the company after 2 months at $12. What if after 2 months the price of this company's share is $25? Because I purchased the option, I can still buy it for $12, which means at the expiry period, means after 2 months, when the market price of the same company share is 25, I will still have the opportunity and entitlement to buy it for $12. But what happens after 2 months if the market price of this share is $8? Do you think I will exercise my option? If the market price is 8, why would I buy for 12? What I will do is I will not exercise my option. That's why I said a call option or an option gives the holder of the option, I'm the holder of the option, I purchased the option, I'm the holder of the option. It gives me the right, but not the obligation. So I am not obligated after two months to buy it for 12, no matter what the market price is. What I will do is I will see what is the market price. If it is 8, I will not exercise my option. Why should I buy for 12 when it is available in market for 8? But what if it is after 2 months for 18? I will not buy for 18. In fact, I will exercise the option and I will buy the shares at 12 because this call options entitle me after 2 months to buy the shares at 12 even if the market price is 18. And if this happens, if I buy the shares at 12 and immediately sell it at the market price for 18, I make a profit of $6 here. From this $6, if I minus the option premium which I paid for $3 to get the option, still I'm making $3 profit. But what has happened? I have managed the risk. Call option is only purchased when we know that the price of a particular share is going to rise, the trajectory is going up, okay? So we don't want to pay more in future because now we don't have the money to buy the share. So what we do is instead we buy a call option which gives us the right, even if the price goes up to, according to my estimation, it will go up by 15 or higher. So it is 18 after 2 months. So just spending $3 helps me to buy shares, as many I want, for $12, where the market price is 18. If my forecast was correct, I'm buying for 12 at the expiry date, I sell it for 18 at the market price, I make $6, I minus $3 which I paid as option premium, still I'm making 3 per share. So that's how I limit my losses. Had I not purchased the option, today the price is 10 and after 2 months if I buy, I will buy for 18. That means the risk is too high. Why the risk is high? Because the price is going up. So I hope you understand what is a call option. A call option gives the option holder, which is me, who purchased the call option, the right and privilege to buy a particular share at a particular price at or before a particular specified date. But all this is not mandatory. It's up to me. I will see after 2 months what is the market price. If it is $8, I will not exercise my option. I will do nothing. And if I do nothing, all I'm losing is this $3 which I paid. But what if the price is $28? At the expiry date after 2 months, I still have the option of buying the shares which are available in the market for $28. I can buy for $12. This is the beauty of call option. Now let's talk about put option. Put option is exactly the opposite. Put option generally is purchased by people who already have shares of a particular company and they're scared that is in future the shares which they already hold in their portfolio, what happens if they want to sell and the price is less? So put option is purchased by people who are expecting the price of their currently held shares to fall. For example, today I purchased a put option of ABC company. The price of the shares are, let's say, $15 today. I paid a put option premium, means I paid some amount to buy the put option, let's say for $4. And then it entitles me to sell the shares which I already have after 3 months. If after 3 months the market price of these shares, today it is 15, if after 3 months the market price of these shares fall to 7, because I purchased an option, this gives me an option to sell the shares at $14 each. So the beauty of put option is if you are holding a share already and you are forecasting and estimating and you are expecting that the price of the shares will fall in future, and by the time you want to sell, let's say you want to sell the shares after 2 or 3 months, by the time you sell the shares, what if the price has gone down? Obviously you make a loss. So what you can do is you can limit your loss by buying a put option which entitles you to sell it for 14 after 3 months, even if the market price is 7. So as I said, after 3 months, it's not an obligation for you. It is an option. If you want, you will sell. So what happens? Today the price, transaction date price of the share is 7. You already have the shares with you. You paid $4 as a put option premium to purchase the option, which entitles you to sell it for 14. So after 3 months, if the market price is 7, obviously you sell it for 14. But what if the market price is $20? Will you still exercise the option? No, because if you exercise the option, you will sell for 14, whereas the market price is 20. So you will let go the option. So if you let go the option, all you lose is $4. But what if the market price is 7, you sell it for 14, you make a profit of $7. Out of 7, you minus 4, you're still left with $3, which is a profit. So this is how we hedge. We limit our losses by buying a put option, because we are scared the shares we already have in a portfolio, in future their price may fall down, and in future if we want to sell our existing shares, we may not get the same price. To reduce the loss, to limit the loss, to hedge against the loss, we buy a put option. So put options entitles the option holder to sell a particular share of a particular company at a particular price after or before a specified date. Here there are some technical terms you need to understand. A person who has the option, which means if I purchase the option, I purchase it from you. You are the writer of the option. If you are the writer of the option, I am the holder of the option. I purchase the option. So with me lies the option, whether it is call or put. If it is call option, I have the option to purchase a share at a particular price at a particular date. Okay? But if I have a put option, still I have the option to sell the shares at a particular price at a particular date. But you don't have any option. For me, I have the option but not the obligation. But for you, you have the obligation. Which means if I have a call option and you have sold me the call option, that means I will like to purchase shares after 2 months F12. If I exercise my option, you are obligated to sell me the shares at $12. If I have a put option, I already have the share and you have sold me the put option, which gives me the option to sell the share at a particular price at a particular date. And if I exercise the option, then you have to buy the shares from me. Okay? So the person who have the option is known to have a long position. So if I am the option holder, whether I have a put option or a call option, I have a long position. If you are writer of the option who sold the option to me, you have a short position because you don't have any decision making options with you. Option premium is the amount which you pay to get the option. Here it was $3, here it was $4. Strike price is at the price which you are going to sell or buy the shares. In this example of mine, this is the strike price. I had the option to purchase shares at 12. In put option, I had the option to sell the shares at 14. These are called strike price or exercise price. Transaction price is when you purchase the call option or put option at that day, what was the price of that security, of that share. Expiration date is this 3 months or 2 months. That depends on the contract. There are different types of options. One of them is called American option. In an American option, let's say if you have a call option, means you can purchase the share and you have an expiry date. So under American option, you can purchase the share from the date you have the option till the expiry date, anytime before that or on the expiry date. Anytime from the date of purchasing the option till the expiry date, anytime before the expiry or on expiry, you can exercise the right. The other type of option we have the European option. European option is an option which can only be exercised at the expiry date. Means only after 3 months or 2 months, not before that. The third type is known as the covered option. Covered option is a call option which the writer sells. Let's say I'm selling you a call option. And call option, if I sell to you, you have the right and privilege to buy a particular share at a particular price at a particular date. But if I'm the option writer, I'm selling it to you. Covered option means if I'm giving you the option to buy a particular stock, that stock is already with me. I already hold that stock. Which means if you exercise your right of buying the stock at a particular price, whether high or lower than the market, obviously it will be lower than the market. But the thing is, I am obligated to sell. So if I'm obligated to sell, I already have those stock, those shares with me. You understand? So if you exercise your call option, I have those shares which I promised that I will sell you for 12. That is called covered option. So in a covered option, what is my loss? My loss is if the market price is 25, I have the shares. I've sold you the option which gives you the right to buy it for 12. So instead of selling the shares which I already have at market price which is 25, I'll be selling it for 12. So obviously I'll be losing $13. The only thing I earn is when I sold you the option, I got the option premium. That is my only amount which I have earned, nothing else. The last type is called naked option. Naked option is very, very risky, where I am the option rider. I sell you the option of a call option. That means which gives you the right to buy a shares of a particular company at a particular price at a particular date. But the problem is I am giving the option to buy the shares. Those shares are not in my portfolio. I don't hold those shares. So the problem arises if you exercise the option. Let's say I gave you the option to buy the shares at $12. These shares are not held by me. So if you exercise the option to buy the shares at 12 and at that time the market price of the shares are 28, because the shares are not already held by me, I don't own those shares. So what I have to do, I have to purchase those shares from the market at 28 and I'm obligated to sell you at 12. So that will be a major blow for me. The naked option is only used by people who sell the call option and they know that the market price is going to be less, not more than the transaction price. That is the only motive we sell. But if we are not sure that the market price is going to go less, going to go down, if it's going to go up, obviously then there will be a phenomenal loss we have to bear. There are certain terms used in this derivatives, the options, something called in the money. In the money means, what if I have a call option? The market price is high, let's say market price is 28 and my strike price is 12. This is your market price. I have a call option and I have a strike price of 12. That means if I exercise my option, I will buy for 12. So I will say I'm going to exercise my option because the deal is in the money. In the money means I'm buying shares for $12 each, which has a market price of 12. At the money means the market price is also 28 and I am also buying at 28, let's suppose. So that means at the money. Out of the money means the market price is 18 and I am supposed to buy it at 20 if my strike price is 20. Obviously it is out of the money. I will let the option go and I'll let the option expire. Obviously if my strike price is 20 and the market price is 18, I'm not going to buy something for 20 which is available in the market for 18. So obviously I'll let it go and I will call it out of the money. There is another term used as intrinsic value. The intrinsic value of an option is actually when the market price of the security is high and our strike price is low. Only then we say that the option has an intrinsic value. Obviously, intrinsic value will be the difference between two. So now I'm going to discuss a practical question in which a person tries to hedge to minimize its losses using options. So here I have a question. It says, an investor wrote a 45 call option. Please remember, when an investor wrote a 45 call option means I am the option writer. I am giving you a call option. That means you are going to buy and I am going to sell. So what is the strike price? 45. And purchased a $50 put option. Means I am buying a put option which helps me to sell the shares which I already hold. If I'm selling you a call option, that means you will purchase and I will sell you the shares. Obviously the shares which I already have. Okay. But when I sell a put option, that restricts your ability to buy the shares at a particular price, meaning the strike price. And I have the shares for which I have the option to sell it at a strike price, obviously looking at the market. So an investor wrote a call option, means I'm selling you a call option, you can buy the shares at a strike price, and I also have a put option. If I have shares with me, I can sell those same shares at $50 after some time. Expiry dates are same for call and put option. On the transaction date, when I sold the call option and purchased the put option, the price of the stock was $45. The price for call and put options were $8 and $10. Obviously, $8 was for call option and $10 was for put option. So obviously when I sold the call option to you, I got $8. When I purchased the put option, I paid $10. What happened? At the expiry date, the stock price fell by 10. That means it was 45 on the transaction date. It fell by 10. So that means the market price has become 35. What is investor's total profit on the combined option position, ignoring all commission and fees? So let's have a look at this. When I sold you an option for 45, call option, that means if the market price is 35, would you buy for 45? The answer is no. Okay, I'm selling you a call option, that means you're supposed to buy. So at the expiry date, would you purchase something for 45 if the price is 35? The answer is no. So you let go the option. In that case, for me, who's the investor? What did I earn? I earn the amount for call option. You paid me $8, so I earned $8 from you. Now let's talk about, I have a put option. I can sell shares for $50. At the expiry date, the share price was 35. Don't you think if the market price is 35 and I have the opportunity, the right, the privilege to sell it for 50, I will. So if I do that, if I sell using my put option, which I purchased, obviously I'll sell for 50 when the price of the share is 35. So I am gaining 15, right? But for this put option, I also paid $10. So I paid $10. So what is happening? This is what I paid and this is to what I earned. This is the option premium which I got from call option. This I earned, this I earned. So 15 and this will be 23 minus 10 is $13 is the total amount I earned using call and put options simultaneously to hedge against the same stock. So guys, if you have any questions relating to options, call option, put option, what is strike price, what is expiry date, what is long position, short position, how to calculate gains and losses, feel free to leave a comment. I will reply to you. If you're not yet subscribed to my channel, please subscribe to my channel. That's one way to show that you value my work. If you like this video, please share it with your dear and near ones so that others can also benefit. Thank you so very much for your precious time. Love you all.